Very warm morning to all our participants. Thank you for joining this very important chat about the new tax act in Nigeria. Thank you to our panelists and in-house panelists from Andersen. Thank you to managing partner for joining in. This is a very important topic to be heard. It's been ongoing for quite a while. We know that we now have the Nigeria Tax Act, the Nigeria Tax Administration Act, the Nigeria Revenue Service Establishment Act. And so from next year, we'll no longer be referring to FRS as FRS, we'll be referring to FRS as Nigerian Revenue Service. We also now have the Joint Revenue Board, Joint Revenue Board Establishment Act. So a couple of things are changing. People have been talking about this, but it's important for us as professionals to talk about it, giving specific insight on key provisions that have significant implications for taxpayers. There are things that are attracting the buzz everywhere, but we think that there are salient issues to be discussed. And so the goal of this webinar is to have those critical conversations on some of those significant provisions, those that are been newly introduced, the amended provisions from the new act, and of course, talk about how they would they have implications for your business, various business sectors. And of course, we've got our panelists that will be shedding light on those areas as we talk about the deeming provisions with respect to controlled foreign corporations, issues around the capital gains tax, issues around the value-added tax, the input and output VAT, even fiscalization for the purposes of VAT, and of course the revised tax ban for personal income tax, things around tax planning strategies, and how you should disclose what strategies you're using as an organization and advance ruling. So we've got the conversation very packed, and all that we're trying to encourage you to do today is to stay focused and let's have these important conversations. Be part of the conversation. Post your questions in the Q&A as we go on, and then we'll make the most of the time before us. And so before we continue, I would like to invite our managing partner at Andersen in Nigeria and the co-managing partner for Africa, Andersen, Olale Adebi, to give us the opening remarks as we continue. Thank you.
Yeah, thanks, Simitokwe. And thank you, everyone. Welcome to our webinar. Today is a continuation of our analysis of the changes that are going to start happening from January 2026. The law there are very many provisions, and so it's not something we can cover in a single webinar. So today we are looking at those key provisions that we believe are going to have significant implications for taxpayers. So there are many others that we're going to be covering in our other series. So as you can see, there has been so much interest in these new changes to the tax acts in Nigeria. We have many amendments to the tax law in the past, either through the Finance Act or even through laws in the past. Well, this is the first time there's going to be such a significant review of the tax laws. So which is why I think everybody is now kind of more interested in what is happening, because one way or the other, either you're on a small business, you're on a big business, or even if you are just a salary earner, or you are a retiree, or one way or the other, this new tax law will affect you. Or for businesses that are going to be required to be connected to the e-invoicing system, or even professional services who are not supposed to represent their client. You have to be qualified in a way to represent your client. There are many changes that are going to be happening as from next year. So what Andersen has done in the recent past is to kind of focus more on sectorial analysis, and we look at the manufacturer, look at financial services, and say, how does this law affect you in particular? But today, we are not looking at any particular sector. So we are looking at key provisions, that covers many areas. And in a way, we want this webinar to be as interactive as possible. So please post your questions. It will not be possible for you to interrupt the speaker at any point in time. But please, we are going to allow time for Q&A. So post your questions so you can be prepared. Whether you're an advisor or you're an in-house tax person, this law needs to be understood as much as possible because there are significant provisions for that affect businesses as a whole and business people. So, I welcome you to the webinar. My team of experts are here to address any issue you need to be covered this morning. Partner Chinedu Ezomike is here. Our partner there, Madeleine, is here. Our partner there, Chiwendu Enechi, is also here. Then the moderator is Timi Tokwe, and Koladis is our associate director in the firm. So, welcome everyone to the Andersen webinar. We expect to be able to share our experience with you. But we don't say we know it all. We also need to listen to you to know your views. So I commend you all for the next an hour and a half or 2 hours as we start this process. Thank you all.
Thank you very much, Lei, and thank you once again to all attendees, participants. Like you've been encouraged, please be part of this conversation. If you've got questions, just post them in the Q&A. It's a chat we want to really have. We're not making any presentation. We've got some conversation starters, and I'll do a bit of introduction of the panelists so that you know that we've got very seasoned tax experts to have this conversation. My name is Temitope Kolade, and I'm an associate director with Andersen in Nigeria. I'll be anchoring this session, but then I have very seasoned panelists. Chinedu Ezomike is a partner and head of commercial practice. He's got over 17 years of experience in providing professional tax and regulatory services to clients in various industries. He leads his team to provide professional services to companies in various sectors, the consumer markets, the industrial markets, transport and financial services. He's worked with several corporate clients and individual clients at the same time. He's been involved in several corporate tax planning, tax due diligence, tax advisory, and compliance for local and multinational companies in various industries. So he's also led several advocacy efforts. He's got a bachelor's degree from the University of Nigeria. He's got a master's from the University of San Francisco. He's a member of the Institute of Chartered Accountants of Nigeria, the Chartered Institute of Taxation of Nigeria. He's got affiliations with the Lagos Business School, the Enterprise Development Center, and of course, he's also a member of the Chartered Institute of Management Accountants. His areas of specialization include tax audits management, tax advisory and regulatory services, tax training and capacity development, tax compliance and dispute resolution, and tax strategies and optimization. Thank you again for making out this time, Chinedu, to join this conversation today. Again, I move to Chiwendu Enechi. Chiwendu is a partner within the energy, mining, and maritime practice in Andersen in Nigeria. He's got over 14 years providing workable tax management and advisory solutions to companies in the oil, gas, and power sectors. Before joining Andersen, he spent a couple of years with one of the big four accounting firms. He rose to the post of a manager, providing tax services to both local and multinational companies. As a thought leader, he's written several articles on tax and compliance matters. He participates in panel discussions with respect to tax issues in the oil and gas business space in Nigeria. It's facilitated many local and international trainings and is led several advocacy initiatives of major industrial associations in Nigeria. He's got a bachelor's degree from the University of Benin. He's got a master's from the University of San Francisco. He's an associate of the Institute of Chartered Accountants of Nigeria, the Chartered Institute of Taxation of Nigeria. He's also a member of the Chartered Institute of Management Accountants, the UK. And so thank you, Chiwindu, for joining this call. It's always very interesting having tax conversations with you. We've got Yemi Adediran on the panel also. Yemi Adediran is a partner also within the Commercial Service Group. He's got over 16 years experience in providing tax and compliance services to clients, both local and multinational. He started his career, professional services career in particular with KPMG in Nigeria. He rose to the post of manager, and then he joined the flour mills of Nigeria PLC, where he was a group tax manager. And for very many people who know that company, it's a company that that's like the largest manufacturing conglomerate in Africa. He's collaborated with multidisciplinary teams of middle and senior management personnel in various organizations. He's led several engagement teams to provide tax advice on various taxes, including CIT, companies income tax, personal income tax, the transaction taxes. He's developed relevant network contact relationship with regulatory authorities. He has a bachelor's degree from the University of Lagos. He's got a master's from the University of San Francisco. He's an associate member of the Institute of Chartered Accountants of Nigeria, the Chartered Institute of Taxation of Nigeria. He's got a diploma in International Financial Reporting Standards, the ACCA, and his core area of competence is tax advisory and compliance, and of course, tax advocacy. Thank you, Yemi, for joining this chat. And so very quickly, we go into the business of the day. Like I've encouraged you all, participants and listeners, viewers, please, if you've got questions, we want this to be a chat where we really rub minds and have conversations on the important issues and how they would affect our businesses and, of course, our personal. If you could say your pockets, your bottom line, starting from January 2026, right? So I'll start by posing some questions to Chinedu. Chinedu, a lot is being discussed with respect to this new tax act. And I'd like to get your views to start with. People will typically talk about tax planning. They will talk about the need for, some people will talk about tax avoidance, tax evasion, and they would say, oh, tax avoidance is fine. And so it's important to always plan your affairs. And a particular judge has even ruled in a case law to say that there is nothing wrong about planning your affairs. But one thing is interesting about this new tax act. It says, yes, it's fine for you to plan, but when you plan, you've got to let me know that you're planning. And so the question is, how does it become a strategy, or what exactly is a strategy? If that strategy becomes public, or at the best, it becomes open to the other party who is supposed to be regulating and looking at what exactly you have planned. So that's Nigerian Tax Administration Act introduces that requirement for taxpayers to disclose activities that taxpayers intend to achieve by taking a tax advantage. And of course, there are conversations around what a tax advantage is, basically tax avoidance strategies. So how will company approach these, and what does it mean for tax planning going forward? What does it mean for consultants that would help typically taxpayers to plan their affairs to ensure that they've optimized their tax position?
Okay, thanks so much, Tobe, and thanks for having me. At every opportunity I get to speak on this new tax law, I always like to start by commending the team. The committee, Taiwo and his team that did this work. I think, despite all the challenges, they pulled it through. The intent was very good. The level of coordination and consulting that they did was excellent. And there is no tax law that will be perfect, but compared to what we had before, and the intent behind it. I think they did a good job. So we should always commend them. So when we comment on the provisions, it's not in any way to discredit, the work that was done. It is to, keep looking for how to improve it. Now, specifically to the tax planning disclosure, yes, in theory, the taxpayers and the tax authorities are not supposed to be adversarial. They are supposed to kind of work together. So to that extent, any amount of disclosure to the authorities that helps the business is welcome. But the fundamental issue will always about trust. What was the trust quotient? How do the taxpayers really trust the tax administrators as at now? Because we know that companies that have tried to comply and in some aspects tend to over-disclose might then become targets of additional scrutiny. While the companies that sometimes are opaque in their disclosures, because you don't have enough information to go after them, tend to, in the long term, fare better. But that was in the past. The FRS will have to build trust to show that their own perspectives have changed. That if a client or a company discloses a tax planning opportunity to them, that it wouldn't then become an avenue for witch hunting or to keep scrutinizing their books more and more. The positive part of it is that, again, in theory, the more the tax administrator knows about your business, the easier it is for them to audit you. In fact, I believe we are getting to an era where not every company should be audited every year. We should be getting to an era of risk-based audit. So if the e-invoicing project goes well, if the tax planning opportunities are disclosed properly and helps the FRS understand the business better, they can actually do their own high-level reviews from their office, and maybe they don't need to do additional reviews for the companies, additional audits every year. So I'm an advocate of the fact that you cannot effectively audit a company you don't understand. So to that extent, as much disclosure as possible to the authorities is welcome so that they understand the business and be able to effectively audit you. But they, on their part, have to demonstrate that that they won't use this as a tool to then keep hitting the companies over their head. Because I remember when we did VADES, a few years back, and some companies that in good faith came out to disclose their businesses and their information kept getting letters and follow up after that, while those that ignored the whole process never got any queries. So such things don't build confidence. This FRS, which is heavily led, we have to continue to build confidence with the taxpayers. Thank you.
Thanks a lot, Chinedu. And I like the fact that you talked about the trust quotient and the fact that you also were very careful by saying some things are theoretical, so to speak. So the taste of the eating is in the, the taste of the pudding is in the eating, right? So it's only when the implementation begins that we'll begin to see whether FRS or NRS, the new name, right, would build that trust and get everyone to have a good handshake such that it's not adversarial in terms of the relationship between the two parties. But thank you very much for those very useful insights. So I'll come to you, Yemi. So the Nigerian Tax Act has got some interesting provisions that could make the profits of a company that is outside Nigeria to be deemed distributed in Nigeria, right? To the extent that they have a parent company in Nigeria. Of course, in this case, the NRS, that's the Nigerian Revenue Service, will be taking the position that such distribution can be deemed not to be detrimental to the business of the subsidiary. So this is the case. I have company A in Nigeria, it's got company AB, which is a subsidiary, say in Ghana or wherever, right? And there are profits to be distributed by the company in Ghana such that the parent company in Nigeria, A, is able to say, I have dividend income, but for whatever reasons, they say, oh, I want to plow it back for organic growth, right? If they don't do that, FRS could say, hey, if you had basically declared this dividend, right, it wouldn't have been something detrimental to your business regardless. So the question here is, should the service in reality be a party to determining whether declaring or not declaring would be detrimental? What is the business of the regulator, so to speak? And this is just I'm just going into the mind of certain taxpayers and maybe some of our participants to say that, yes, what's the concern of the regulator, in this case being the Nigerian Revenue Service, to say you should have declared, and if you declare, it won't spoil your business. Do you know how I run my business? Again, in the minds of some of our potential taxpayers or clients, and then what sort of regulations will be necessary to make that determination, and what metrics, what thresholds should guide any such decision? Should there be things that we should really be looking at such that both parties are clear that, oh, if it's maybe this particular profit before tax, for instance, or the health of my business is checked for a couple of years, say 5 years, and I can demonstrate this, then both parties will be clear that, okay, indeed, there wouldn't any detrimental impact if I declare that. Gary?
It's a lot of, it's an interesting position, and it's not uncommon. What you just described is what they call CFC rules, which is controlled foreign operation rules, and many advanced economies have those rules. And the aim of that rule is to prevent profit shifting and base erosion. In essence, Nigeria is saying that if you are a Nigerian company and you have control over a foreign company, we don't want you to arrange your activities in such a way that you shift profit from Nigeria to that other country. Perhaps that country has a low tax rate, and which is lower than what Nigeria would have taxed those profits. So Nigeria is saying that, okay, I'm going to include these provisions in the law so that I can protect my tax base. And it's important for us to read the fine wordings of the law. It doesn't say if you are a foreign subsidiary of a Nigerian company. It actually used the word control. So if a Nigerian company has control over a foreign company, and the tax authority deems that the profit that is being distributed by that foreign company is less than what should have been distributed, then they can look into it and deem additional profit to be distributed. Yes, you are correct that it seems to be giving the tax authority enormous powers, to just impose tax based on subsidiaries or companies that Nigerian companies have control over. And it may not all go well for business. But all over the world, if you look at most principles of CFC rules, the tax authorities have always been given the power to make those interpretations. But what usually happens is that those laws or those powers are guided by certain regulations or certain provisions. For instance, there is a control test, and there is also what we call the low tax test, meaning that what will trigger the tax authority to deem a profit that should have been distributed by a foreign company to be distributed. So they can look at, okay, does the Nigeria company have sufficient control over the foreign company to be able to determine profits to be shifted there? Now, what is different in our tax laws is that if you look at the definition of control in the Nigerian Tax Act, it seems to impose a 30% voting powers or shareholder rights to determine control. In most other countries, it's spec at 50%. So what it's saying is that, if you have control over a company or you have voting rights or subsidiary rights over a foreign company, to the extent that those powers exceed 30% or is 30%, then it could trigger the FRS to look at the arrangements between both companies and deem certain profits should have been distributed to the Nigerian company. So I would say that, yeah, we have taken it a notch higher from 50% to 30%. The other thing I would say is what would trigger the FRS to look at that is if that foreign company that is being controlled by the Nigerian company has a tax rate that is less than the 15% minimum effective tax rate that has been stipulated in the law. And I think that's what is really recommended globally. So if the FRS sees these two triggers, they can look at the arrangement and then determine whether maybe they should deem additional profit. But like you said, I think there should be some trend analysis, some more detailed guidelines on how the tax authorities would apply this so that it can give companies some comfort, to spread their operations around the globe without being surprised by additional taxes that will be attributed to their operations in foreign companies and then payable to the FIRS. The committee has promised detailed guidelines that would back the provisions of the law, and I hope that those guidelines will come in before January 1st when the laws become effective.
Thank you so much, Yemi. I like those very, very useful insights. I like the fact that you've also talked about what's happening in other jurisdictions. So maybe it's safe to say that our tax laws are becoming a little bit more sophisticated, so to speak, and Nigeria is trying to protect its own turf when it comes to what revenue share comes to it from whatever happens within corporates across the world. And the conversation on effective tax rate is something that, of course, it's very interesting, and we'll delve into it a little bit after now. But then I want to come very quickly to Chinwendu. Chinwendu, you've been doing a couple of work with the shipping companies within the maritime sector, and someone just said, whether true or not, that before now, shipping companies will come to Nigeria and they say, when we're going, we have nothing to go with. But we now have Dangote refinery, so there is something to go with. And the law has always been that, yeah, you come into Nigeria for shipping and air freight companies. When you take something out, then you've got to pay some sort of tax, right? And so the question really is about what's the new requirement for shipping companies? Is there something that shipping companies now need to be aware of? We are aware that the FRS in the last couple of years or months, I would say, have been trying to see what they can get from that sector of the economy to ensure that shipping companies also fulfill their tax obligations within Nigeria when they come to the Nigerian waters. But they're even taking it not much higher to say that before coming to the Nigerian waters, then there are certain requirements. Do you want to speak about that to our participants?
Thank you so much, Toplet, and thanks for having me. It's a very, very interesting one, if I must say. Just like you rightly said, the maritime space, particularly the guys that the non-resident companies that are coming to the country to lift crude. Over the years, it has been a very tough one for the FRS in terms of cracking that space with respect to enforcing compliance. When you look at our local laws, particularly the current CETA for the Companies Income Tax Act, there's a provision that requires these companies, to pay taxes with respect to cargoes lifted from Nigeria. But because of the nature of those transactions and the fact that those companies are non-resident, over the years, it's been very difficult for the FRS to get a hold of these companies. Sometimes you have instances where some of them come in once and never come again. But in recent times, there's been a lot of traction in that space, with FRS eventually being able to go after some of these companies issuing notice of assessments to them, and we've seen some level of compliance. Just like you did mention, I've done a lot of work in that space, advising companies on how to regularize their taxes. And one of the questions that we always get from clients is with respect to how is FRS going to enforce this new provision. And I think it's coming from a provision that was introduced in finance, I think it was 2021, that required these companies to provide some form of evidence of tax filing to the regulatory authorities before their cargoes are able to leave the country. One of those is, I think, was tax clearance certificates, which will essentially show that we pay taxes in the last three preceding years. So that tax clearance certificate will typically show that the income taxes that you have paid. Now, those provisions have then been, carried forward into the Nigerian Tax Act. But one very interesting one that was introduced, which even for us, it's a bit worrisome, is the evidence of tax declaration and payment in respect of intended carriage or shipment. What that essentially means is that these companies are then required to show evidence of tax payment or declaration, as it were, for the shipment that they are about to carry. Now, if you understand how that industry works, sometimes when these companies come into Nigeria, they will typically pay NIMASA levy. And NIMASA levy is typically, computed on the basis of an estimated freight income. Because the actual revenue that the companies will earn will typically depend on the number of days that they spend in Nigeria. But you've got to pay that NIMASA levy on an estimate. So they will come up with an estimate and pay that. So if I follow what happens with respect to paying that NIMASA levy, what I think would then happen with this new law is that these companies will also be required to make tax payment on that estimate on the base that they used to compute the NIMASA levy. Don't forget that they're also required to file monthly returns. And so it then begs the question, monthly returns will typically follow the nature of VAT and withholding tax that we typically do, which is you file at the end of every month for the previous month, which is how we expect this to happen, in terms of implementation. So we get this question every time when clients are asking us, so how is this going to be implemented? And to be honest, we have been having conversations with the FRS to say, look, how do you intend to implement this, where you're asking taxpayers to actually show evidence of tax payment for the shipment that they are just about to carry? For me, it's a very interesting one. We don't have the answer yet, but we continue to engage the FRS. What we assume will happen is that it will follow the same the manner that the NIMASA levy is computed, where you then come up with an estimate. You say, okay, this is the estimated freight income on this carriage. And the expectation is that before the cargo then leaves, you have to make payment, tax payment for that shipment, and then do some form of reconciliation at the point you are filing your monthly return. And then, of course, at the end of the year, you are still required to file the annual return and possibly do a reconciliation as to whether there's overpayment or underpayment, which is similar to what you have in the upstream sector, where companies file an estimated return in February, and then in May of the following year, they file the actual return. And where there is some differential, you then have to make up that, or where you have overpayment, you take that as a credit. So we kind of assume that may be what will happen. But again, the expectation is that the FRS will most likely issue some circular or some clarification with respect to how this implementation will really play out, because it's a burning question that clients are asking to say, look, how is this going to play out? If I'm going to have to make payments for shipment that I haven't even carried yet, how is that going to happen? But if you ask me, I think we were surprised to see that. For the other ones that were there that were introduced with respect to providing TCC, that is pretty straightforward. It's common in Nigeria, where taxpayers are asked to provide tax clearance certificate to sort of show evidence of tax compliance in the last 3 preceding years before you obtain some form of regulatory permit. So I would think that that is just treating the non-resident as Nigerian companies are treated when it comes to obtaining some form of regulatory permit. But the additional requirement for payment of the taxes on intended carriages it's a bit it's a new one that we all still trying to navigate. Hopefully in next year, come January 2026, we'll get a bit more clarity in terms of how this will really be implemented. But our guess is it will follow the manner in which the companies in the upstream sector pay estimated taxes. And then you file an actual return, which then shows what the actual tax should be. And then if there's any overpayment, you take that as a credit.
Thanks a lot, Chiwendo. Apparently, these changes are impacting almost every aspect of the economy, and that's why I believe we've got over 250 participants on the call trying to understand what this is about. And I'm sure many more will join. So the conversation is getting interesting. One of our participants has already asked a question, and I think, Chinedu, you take that question together with the one on CGT, right? You had spoken about tax planning earlier, and this person is saying, what exactly is tax planning to avoid over disclosure? Can there be an over disclosure of what your strategies are to the FRS? I know you had talked about trust. And so even when I trust, does it mean that I should open up my so-called cooking pots, right, to every outsider, so to speak? And I know that the FIRs or the NRS in this case would like to say that we are stakeholders in your business. We have a share in your business, whether you like to hear it or not, but that's the reality. And so this person is saying, what exactly is tax planning to avoid over disclosure? And I'll then ask you to also speak to one very important issue that people have been talking about as well, the impact of CGT. Some have even said that, oh, maybe some people will sell off their investment before the end of this year because the rates will change come January 2026. And the question would be whether investors really take decisions based on tax only. There are concerns around the introduction of CGT on indirect transfers of shares in Nigerian companies, such that where shares are disposed of in the intermediary holding companies that are offshore in Nigeria, CGT is triggered. So what does that mean for business or for businesses, and what should companies be doing now? Should they be taking that position of, oh, we want to sell off every investment that we have in Nigeria because we want to avoid paying so much of CGT, so to speak?
Okay, I mean, thanks so much. So that's a lot of questions, and I'll try to take them, one by one. So first, and I think the question that the audience asked is a very good question, because what constitutes tax planning is vague. The term tax planning is actually a vague term. Anything can be called, tax planning. There is no beginning to end and end it. But in this context, it will have to be of a complex nature in terms of how a business decides to organize their affairs internally, either transactions, holdings, and all that. Now, I've always said, and I believe that FRS is a shareholder in every business, right? FRS has 30% at least, or maybe 25% if you eventually get the executive assigned, 25% equity in every business. So they are part of the business. But the issue around disclosure, I mean, at some point, FRS will have to come to look at the books. So again, theoretically, they will have to see everything. But we know in practice that at what point you want them to come and say it. And that's why I was trying to explain the pros and cons. The pro of disclosing is that they're already aware, so any audit process becomes easy. So if you disclose to them and they agree with it, for example, so you say, okay, for example, I used to do my business this way, but now I want to do it this way so I can take the advantage of this XYZ. Either it's holding structure or transaction structure, whatever it is. And they know and they agree. the next time they'll come to audit you or review your books, the level of questions, the level of disagreements will be reduced. And they might be so comfortable with it that they don't even have to come to review you. That's the pro. Now, the con is that either they disagree with you or it spotlights the business as a business who tries to take advantage of, tax provision or tax openings or tax planning and all that. And then you start getting a lot of scrutiny, a lot of queries, a lot of reviews, and it disrupts your business. Most places are not averse to tax audits. So FRA, because they know that they will always come, but they are averse to desk review today, audit tomorrow, investigation next tomorrow, then next day another review, then another office then comes, then another fraud investigation, then another. It becomes very, very disruptive. And the question will be, why do I want to go through that? Why will I call that upon myself if that's what's going to happen? That's what I'm saying, that FRS will have to demonstrate that that's not what's going to happen, that they're going to take it in good faith. Even if they disagree, they will just write it and say, okay, we don't agree with this or something, and that'll be the end of it. Not that you then get a letter to investigate or a letter to audit based on that. So that's what I was explaining there. Now, to the issue of the stock market and then how it affects business structures, I think that is one of the most important aspects of these new bills. When the bill started initially, there was so much noise about the VAT allocation, and then there is issue. I mean, there have been other matters that kind of distracted companies a lot. But in terms of how businesses are organized in Nigeria, these changes in the definition of company, in the CGT, in the stock market, and all that is fundamental. And let me give you, a bit of background. A few years ago, there was no CGT on sale of shares, and there was a reason for it. Our stock market is still very small. It's very fragile comparatively, compared to South Africa, for example. So we're trying to encourage more investments, especially foreign investments. Now, we know that then after that, of course, it was put back on CGT, and that was 10%. And people were fine with that generally. Now, we know that most investors that came into the country to invest in stock markets pre-2023, if you are seeing the market today, you know that they have really not made any gain. If you look at the exchange devaluation, the significant exchange devaluation, as well as the high inflation. And unfortunately, CGT is based on your Naira gains, not on your FX gains. So if you brought $1 million at exchange rate of, say, 360, and now to even get back your $1 million, that 360 need to have made maybe 1.5 billion. That's unlikely to have happened. So in dollar terms, the investor has lost money. So that's one. And in some countries, there is what they call indexing. So you actually get your base adjusted for inflation. So if you bought a share at, say, 40 Naira, but inflation was 20% over the last 2-3 years, that base will be adjusted, because CGT is actually the sell value minus the base, the cost that you put it. But that doesn't happen in Nigeria. So that's one aspect that's getting investors uncomfortable. The significant jump from 10% to 25%. In fact, currently it's 30%. We're hoping that it's even up to 25%. It's quite high. And for every meeting where I've met with the committee, I've explained this, that I understand the intention of matching the highest band of personal income tax with the CIT rate, with the CGT rate, so that people you don't have an arbitrage between classification of earnings. I understand that. But you need to also look at timing. Nigeria just went through a major economic reform. Before this government, the index providers, Morgan Stanley, Financial Times, now these are index providers who they index stock markets, and their indexing their classification allows foreign portfolio managers like the pension fund managers, ETFs and all that, to buy into the stock market. That's what helps activities to grow in the stock market. Now, because of how we manage our FX then, they declassified all of Nigeria completely. We were out. We became standalone. So an average stock fund manager in US or in UK, whatever, will not bring funds to Nigeria. So you see that most of the foreign portfolio investments coming to Nigeria have always been to the CBN instruments only. We didn't have any major activity in the stock market. like from foreign investors. Now, we've gone through these very painful reforms. Finally, the Morgan Stanley and the Financial Times, they are beginning to indicate that the reforms are working. The macroeconomic indices are stabilizing. We are still very fragile though, but it's looking good. We have passed the corner, and we have turned the corner, and things are looking good. So that I think the classification, they start with emerging market and then frontier market and all those kind of things. So Nigeria is getting back. We have not even gotten back, but they have indicated that they're looking at it and they're going to put us back. I'm not sure this is the time to then implement an exit tax of 25%. Because why will anybody do that? There is still risk of inflation, major inflation. There is still, risk. In fact, the people that have come, like I said, if they exit today, they're not even sure if they made money. So implementing a 25% exit tax on the stock market gains, I think it will shoot on our first steps in the future. First of all, the tax to be collected is even very minimal because, like I said, we don't have a lot of activities. And if I were a fund manager, I would be considering if there is no indication that this 25% will be either suspended for a while, which I think they should consider, or basically maybe suspend it for a couple of years and see what happens. If you don't do that, there's likely that some people might want to take their profits before December, before January at least, and you create another run on our markets. I'm not sure whether that aspect have been considered. Again, credit to the team that did the work. They consulted widely. I'm not sure whether NGX or the industry players how much consultations they had, but I know that even recently Taiwo was in one of the forums trying to explain the rationale for that. But policy is one thing, how people will behave is another thing. We are not yet as attractive as a country to start putting that level of exit tax. Yes, if you when we fatten the cow, more or less, when we expand the market, when people are confident, when we have stability in the FX and all that over time, then we can start graduating. And I even think if you want to do it, you have to be graduated. Maybe 10%, maybe 15% over time so people get used to it. But slamming a 25% tax on all the gains in the stock market for companies, I know that for smaller players, below 150 million transaction and 10 million naira gain, you're exempt. But those are not the people we're talking about. I'm talking about the real big players who move the markets, who their presence will help our economy, who their presence will increase confidence in our economy. I think we need to relook that. Now, that then moves into the next issue of foreign ownership of companies in Nigeria. Now, before now, and in fact, for the longest while, the standard ownership structure in Nigeria is that you have the operating company in Nigeria, then you put the holding company somewhere in Mauritius or Delaware or Cayman Islands or wherever else works for you. It makes for easy, like if you want to attract new investors, they just invest from the holding company. You want to dispose of your shares, you just dispose the shares from the holding company. If you hear like when some of our fintech companies will have their Series A fund, Series B fund and all that, the investment is usually done offshore. So they will change their shares there and the money doesn't necessarily get taxed in Nigeria because it's a pure foreign transaction. Now, based on the new law, if the underlying assets, which is the operating company, is in Nigeria and the holding company is just sitting abroad, that transaction offshore is subject to CGT in Nigeria. I'm not sure if many of the companies have understood the impact of that because that's quite significant. Many companies are held that way. And not just that, there's also a change in definition of Nigerian company. Again, before now, Nigerian company is a company that is registered in Nigeria and operates in Nigeria. But now we have brought in the phrase, the issue of effective management. If you have a company in the US or you have a company in the UK, but you are sitting in Nigeria running the company, that company is a Nigerian company and will pay taxes in Nigeria. So that, again, effective management issue is a huge matter because most of those holding companies that I mentioned, we have a ton of them in Mauritius, we have a ton of them in Cayman Islands. Their owners are sitting here that control them from here. They might have one or two directors there, but effective control and management is in Nigeria. So these are really, really significant changes And I think most companies will have to start looking at what that means for their business and what they need to do. And again, going back to the issue of tax planning, whether they have to reorganize their business or what level of compliance they require. I think it effectively expands our tax net in Nigeria, and if we can implement it properly, it will really lead to additional revenue for the government. But for businesses, it is an additional headache that I have to think about. Thank you.
Thank you so much, Chinedu. That's a mouthful. I mean, and I can agree more with you that I mean, the sort of changes that we're having with respect to capital gains tax is something that every investor has to look out for, particularly because most of the watchers of the dynamics within the economy currently would say to you that the sort of gains that we made with respect to the stability of the foreign exchange gain is also tied to foreign portfolio investments. Right, but that's not just all about it. I would like that you also chimes in on this conversation around capital gains tax because there are deals within the upstream oil and gas sectors currently, and people are also having these conversations, specifically when you think about it from the point of the several policy changes that we're having with respect to how to get people to participate within the oil and gas sector. A couple of activities are already taking place within that sector currently, and they would also impact, in my thinking, around deals, right? Where some investors are saying, okay, we want some new persons to come in, we want more indigenous players within that sector. How potentially significant could that increase in rate be for deals within the upstream oil and gas sector?
Christopher, thank you so much for that question. And I think it's a very important conversation. Currently or prior to the NTA, CGT or tax has always been part of the conversation when dealing with deals in the upstream sector. Investors would typically want to understand the tax impact of any purchase or any acquisition within that space, particularly for buyers and sellers as well. Because of course, if there's a gain, the seller then will be liable to CGT, depending on the quantum of the gain. So with this new law, I would say that it's a complete shift. It's a fundamental shift in how gains on asset disposal are taxed. And that has implication on both buyers and sellers, like I said. Currently, if you take an example of take a deal of about 1 billion, for instance, $1 billion, a company sells interest in the concession for 1 billion. With the current CGT rates, if the gain is about 400 million, the seller then stands to pay about 40 million in CGT at 10%, which is at 10%. Now, with this new rate, what you have is that the gains are now part of the income of any company, and I will be taxed at the rate of that company's income tax rate. So for the guys who are in the upstream sector, the rate could be as high as 85%, depending on the fiscal regime that you find yourself. If a company has not converted to the new PIA, for instance, and you're still paying tax under the Petroleum Profit Tax Act, you find out that you could pay CGT at a rate of about 85%. So the rate could range from 0 to 85, depending on whether there's a gain. And typically there will be a gain. If you look at when those assets were acquired and at the point you're making a sale. And I think like Chinedu rightly said, there is never an adjustment to the tax base when that conversation is happening. So you most likely have a gain at the end of the day. So you can imagine the significance of that, the change now moving from 10% to as high as 85%. If you look at what is happening in Nigeria, for instance, there's been several disposals by the IOCs, the international oil companies, like Shell, the Exxons of this world, Total, and Chevron. And these guys have sold assets to indigenous players. Now, so you can imagine what will happen where you have more indigenous players looking to participate in asset deals. If you look at what would typically happen in that kind of conversation, beyond the fact that you're acquiring an existing asset, there are also obligations that come with that acquisition. So sellers will want to, when you look at the impact of the CGT, sellers will always want to recoup a higher tax cost. And what would they typically do? Maybe you want to increase the purchase price, to account for that higher tax cost. And when you do that, that then makes the deal quite expensive for the buyer. So when you're looking at that conversation in the local space, how many of these local players are going to be able to raise that capital? Asset acquisition within the industry is already quite expensive, because again, if you look at what is happening at the global level, most companies are moving to clean energy. So when you look at the amount of funds available for development in fossil fuel, you realize that it's been going down. When you look at the S&P 500 measures the top 500 companies that are listed in the US stock exchange. When you look at the oil and gas share of that S&P 500, you realize that it's been shrinking over time. And the reason is quite simple, because investors are looking towards clean energy. Now, what that means is that even the funds available for investment in fossil fuel has diminished. So if there is limited fund, and then you then have a provision that may impact on the pricing of such deals, it kind of complicates everything, particularly for the local players. Because the IOCs will seek to recoup higher tax costs. The new rates will then affect deal pricing, purchase price adjustment, cross negotiations, and all that. So when you combine that with the capital requirement for remediation, security, production optimization, acquisition cost then becomes a bit more expensive, really, when you combine all that. So it's a big issue. So it then puts companies in a position where certain conversations then need to be had in terms of how to evaluate the deal structure. Do you want to stagger it? Do you want to consider exploring options of a staggered deal where the disposals are then done in piecemeal, rather than outright disposal? So what I would do is to kind of reduce the cash flow impact on the cost of that deal, the outflow. If you want to do piecemeal, it kind of reduces the impact of coming up with the full fund, to fund, the full acquisition. So parties may then kind of look into using earn-out mechanism, such that a part of the price is contingent on future asset performance. What that will do is to ease that upfront financing pressure on buyer. Because like I said, this new rate changes the narrative within the space in terms of cost of acquisition. So it's something that investors will want to look into, to say, okay, how do we then structure this transaction? Bearing in mind that you're going to have to deal with potentially a higher purchasing price as sellers look to kind of optimize the cost by recouping some of the higher tax costs by increasing the asking price. So when you spread recognition of gains, for instance, it also reduces the immediate cash flow impact on the buyer. So a lot of tax planning will be required. So what I would say to clients that come to me to say, look, you've got to look at this to see how you can structure that transaction, to see if you can do it in piecemeal, to see if some of the considerations will be contingent on future performance. So it's a time where companies will then need to sit down with tax consultants to look at this deal, because it's no longer going to be business as usual. The implication now is huge, moving from 10% to as high as 85%. It puts you in a position where you've got to really sit down to evaluate the structure of every deal in that space.
Thanks a lot, Chimindo. And I like the fact that you mentioned that it's not business as usual. In fact, for me, I think the devil is in the details. The more you look at this, the more you begin to see the changes that are coming up. But I like the fact that you've also mentioned that there are some planning that can be done around this. Maybe we'll tie back into what Chinedu had said earlier, to say that, yeah, even those planning you've got to disclose from next year. to the airfarers, but he says, okay, we should rely on some level of trust. So, I mean, we can't exhaust these conversations here apparently, and so there would be the need to continue to have these conversations because in just less than an hour, we've explored what's happening within the stock market, how this is impacting shipping operations, oil and gas. But I want to quickly come to manufacturing. Yemi, you've done quite a bit with what's happening within that sector, and I've got a mouthful of questions for you in that regards. You know that manufacturing is something that, I mean, it's for people with patient capital, so to speak, right? People want to go into manufacturing, have got to learn to wait it out until they start having some sort of payback. And from a tax point of view, what companies have always tried to do is to say that can we get some sort of soft landing? And so they go and say we're having something called a pioneer status. Some will register within the free zone, right? And there are some changes in these acts that are impacting on those sort of operations or some strategies, those strategies, particularly when you look at it from the point of the free zone, there is then the issue of at some point down the line, the free zone will lose the tax exemption because what the government is saying to us is that the original intent is that you would produce for the export markets. It's not so much about Nigeria. And some people would say that it doesn't matter where you operate. Once you're within the free zone and it's in Nigeria, you're still in Nigeria. And so for you to really say you have exported, it must cross the borders of Nigeria. So the question is this, that's with this 2025 Tax Act saying that by January 2028, and some will say it's still down the line, those free zone companies would have to sell to the customs territory, and if they sell to the customs territory, then they will be taxed. How will these firms and the regulators also prepare for this transition? What will be the impact on industry output? What will be the impact on foreign investment flows? That's on the one side, like I mentioned earlier. The other part is the pioneer status incentive that most companies within the manufacturing sectors have always relied on, right? Something is also going to give in that regards. And then the law is saying we no longer call it pioneer status incentive to start with. We're now going to be calling it economic development incentive, and you could get some sort of tax credit. Help us understand how that would work, right? And then in real operational terms, how does that new scheme differ from the pioneer status incentive that we currently have? What is it that taxpayers should be looking at doing differently to ensure that they demonstrate impact on the economy? And of course, it's not going to be a lose-lose because, like they always say, there is a cost to every tax incentive that the government also offers. I hope you got my questions. I told you it was going to be a mouthful.
Yes. I think the scope of your question really is respect to the pioneer status and the free trade zone and how it's going to change the dynamics in the manufacturing sector. Yes, the Nigerian Tax Act has really changed a lot in that regard. And if you look at it from the canon of taxation, we talked about neutrality, and that's actually suggests that business decisions should not be influenced by the tax regime. And having listened to Chiwendu on the changes or the planning that companies in the oil and gas sector have to make with respect to the CGT rate going as high as 85%, then you take that back to the manufacturing sector where government is saying that bring your funds in, invest, and don't be influenced by this tax incentive that you want to collect. It's kind of a different messages, when on one hand you're removing some incentives and on the other hand you are increasing the taxes, as it were. But fundamentally, the pioneer status change from pioneer status to economic development incentive I would say if you look at it from a global perspective, it follows what is obtainable in most matured economies. What you're saying is that the incentive should be tied to the investment that is being made by the investor, or what we would say performance-based, as opposed to giving incentives for investment that would have been made anyway. But it's a major shift, because if you look at the pioneer status incentive, if I bring $1 billion dollars into the economy, or let me say $100 million into the economy, into the manufacturing sector, what the pioneer status is saying is that for 5 years, you can make multiples of that amount in profit, and it will be exempted from tax. And the government is saying that in exchange to that, we are hoping that we would have an impact on the economy in terms of jobs created, in terms of opportunities made, and growth in that sector. But the pioneer status incentive actually focused a lot on products. So it's saying that, okay, if you are making a new product, I'm going to give you an incentive for a 5-year period. And generally, if you look at it if you step back and look at that, it's not economic focus, as opposed to what the government is trying to make the economic development incentive to be. It's more industry focused or economic sector driven, saying that there are priority sectors that we are going to focus on for a period or different periods, and we want to grow those sectors, as opposed to a product that a manufacturer has made, and we are glad that you introduced a new product. So if you look at it from that perspective, you'd say that from an objective perspective, the EDI is trying to refocus the objective of the incentive and saying, let it be sector-based as opposed to product-based. The other thing you look at in that regard is that for the EDI, you are saying that the incentive you are going to get is going to be 5% of the investment that you brought in that sector. Meaning that, yeah, you're not going to get more times 5, times 10 of what you are getting, what you could get in the pioneer sector status regime, because that one is looking at tax holiday for a period of 5 years. For investors, what that means is that, or for companies that are exploring the EDI, what that means is that that's 5% of the total value of the investment you have brought in. You actually going to get a credit as opposed to a tax holiday. So the company will still pay tax on that line of business. The only thing is that they would have to then take that incentive and net it off against the tax payable. It may not look so attractive, but I think it stems also from the various articles that the World Bank and the IMF have written over the years, saying that there's a lot of tax leakages with respect to incentives, like the pioneer status, and that government is not really getting returns of what they are giving up in terms of revenue, that they cannot really tie the revenue loss to the gains in terms of employment and expansion in the economy. So I understand where the government is coming from, but for the manufacturing sector and companies operating in that space is a huge departure from the incentive that they've been used to, and may not look so attractive anymore. The other thing the EDI also says is that when you get that credit, you can use it for a period of 5 years straight, as opposed to a period of initial 3 years tax holiday, and then 2 years extension. So you're saying, okay, the 5% can be used as a tax credit for a 5-year period. And then if you've not exhausted it, you can still extend it for another period of 5 years to fully utilize it. What they've also introduced in the past, The regulatory agencies that you would have dealt with under the pioneer status incentive in granting the incentive would have been the NIPC and the IID to certify the productions day and the assets that was brought in for the incentive. But there's a change in that under the NTA, and what they are saying is that, okay, the IID is going to certify the production day, but the Nigerian Revenue Service is going to certify the assets relating to that investment. And I understand the rationale. I would imagine that they're also looking at, okay, since we are going to conduct a tax audit anyway, and you are going to be claiming capital allowance anyway, let one agency look at everything that has to do with assets and in relation to the incentive being claimed. So generally speaking, it's a departure, but it is more predictable. Companies in the past that have obtained pioneer sector incentive, and there's a change in dynamics in the market, and then made losses under that regime. When exiting the pioneer status incentive based on the provision of the tax law back then, they then find themselves in a worse situation because of the commencement rule back then. So that was a bit unpredictable. But here from day one, you know that the credit that you're going to be getting really is just 5% of the investment. And there are also sunset provisions in the law where the years in which we are looking at a particular sector is defined in the law. So it provides a bit of certainty for investors with respect to the incentive that they would be getting. For companies, what they would then need to do is to evaluate how this impacts their business. I would say that if you are going to be making that investment anyway, and you are going to be doing business in Nigeria anyway, I mean, this is just an additional incentive as opposed to making business decisions just to get a tax holiday, which is consistent. The EDI is consistent with global best practice as it relates to incentive. Now, then when we go to the FTZ, yes, another significant change. Well, I won't say significant change. I'll say maybe a cleanup exercise being done there. So what the old regime provides is that companies operating in free trade zone are exempted from regulations and taxes as it pertains to the customs territory. So in that regard, so those companies sometimes could sell to the customs territory as long as, I mean, if you can prove that ownership reward was transferred within the zone, you probably won't be, liable to taxes because you're operating within the zone. So you don't necessarily have to export the products. You can set up a manufacturing plant in the free trade zone and still sell to the customs territory and still be exempt. What this regime is saying is that if you sell above 25% into the customs territory, regardless of where ownership or reward passes, you will be liable to tax in Nigeria. And also by 2028, if you sell any amount to the customs territory, the whole profit will be deemed to be sold in the customs territory and liable to tax. I think there have been some extremes in the last regime, which is where companies are set up in the free trade zone and all their products are sold in the customs territory. It doesn't provide a level playing ground for Nigerian companies because the original intent was for those companies to actually set up in the zone and then export to improve Nigeria's foreign exchange regime. But over the years, we've seen companies mainly set up in the free trade zone just to avoid tax because their business really is targeted as customers in the customs territory. And the government is saying, okay, let's look at this all over again and make sure that, okay, if you're in a free trade zone, you're export oriented, as opposed to creating that difference between custom in the free trade zone, companies in the free trade zone and companies in the customs territory. Also, what it also says in the law now is that companies operating in free trade zone are not exempted from withholding tax regulations. For instance, they would have to deduct withholding tax when they are dealing with companies in the customs territory. So there are some more tax obligations that is being imposed on them. And they will also need to file taxes with the tax authority, the same thing as companies in the customs territory. So I think what the government is saying is that I want, as much as possible, create a level playing ground between companies working existing in free trade zone and companies in the customs territory. And that for companies already in free trade zone, what they will be looking at in terms of their future operations is to see how they can position those operations mainly for the export market as opposed to businesses in Nigeria. I think that changes the dynamics a lot because in the past, all those transactions that were allowed to be carried out in the customs territory wouldn't be allowed. And then companies would then need to look at their investments in those zones vis-a-vis their business strategy, whether it's sustainable. If most of the customers still reside, are resident in the customs territory. The other provisions regards to employees still remains as of old. Employees in the free trade zone were liable to tax. They are still liable to tax currently. So it's a major change which calls for some rethinking for companies operating in the zone. There will still be certain benefits anyway, because if you're importing into the zone, you're exempted from import duties, you're exempted from VAT, and that still has some benefits if you're resident in the zone. So I'd say some benefits are there. It's just that those tax exemptions have been limited to exports to a large extent, as opposed to sales in the customs territory. Thank you.
Thanks, Yemi. Listening to you, I don't know whether to be happy or sad because I mean, wearing the hat of a taxpayer, say that you're basically trying to do a clean out, right? But it is what it is. I guess for our clients would continue to look out for their best interest to see how they can plan their affairs to ensure that they take the benefits. Because again, you've mentioned that there are some benefits that should be taken, right? And it ties back to the questions that I keep asking Chinedu around tax planning. There is also the bit of advance ruling. So Chinedu, I'm coming back to you, right? So similar to the disclosure of tax planning strategies, there is also the provision in the Nigerian Tax Administration Act that says that you could get advance rulings from the FIRS where you ask the Nigerian Revenue Service now to interpret the tax laws for you in certain transactions. And before now, we used to call it like a clarification letter that you also get from the FIRS. But what's more important now is that the law now provides for it, that you could actually approach the NRS to say, give me your interpretation of this. And this is something that applies in other jurisdictions, especially the Western jurisdictions. So the concern here is this. If I'm going to plan something, if I'm going to plan my activities such that it could lead to less tax to the government, in a sense, right? It's optimizing it, but it would mean that I'm paying less. Right. Is there a probability that the NRS would say, you know what, I'm not granting you that advance ruling. I'm going to take it back? Or what do you think? What's the likelihood of success? Right.
Okay, a couple of things first. Like you said, we have always had some sort of advanced ruling mechanism. In fact, in the transfer pricing regulation, it's actually clearly stated you can go to the FRS and get advanced ruling. Now, FRS themselves sometimes, at least in the past, again, I always say in the past because I'm hoping for a new behavior going forward. But in the past, sometimes they're also not very reluctant to show their hand because that would be like, tying their own hands. Because once they give the ruling, they are expected to then abide by it, even though they're not bound by law. I mean, there's no ruling that says that even circulars can be reversed, so they're not bound by it. So it helps everybody. If whether I talk about disclosures or whether I talk about advanced ruling, it helps both FRS and it helps the taxpayer if we abide by the rules. For FRS to give them more clarity. If it's an issue that they were not even aware of before, they can, because they don't have to give you immediately, they can go back, study it, take a position, and then communicate a position to the client, taxpayer. And for the taxpayer, one of the cardinal principles of taxation is certainty. When you do a transaction, you want to know that it is done so that you don't have undue exposures. So if such disclosures and advanced rulings give you certainty, it helps the business. By the time your year close, you sign off, you know that you are sure that when FIR comes, this is how they will treat this matter. There's no risk there. Now, the issue, like I keep saying, is with the FRS in terms of how they see themselves. Are they primarily tax collectors or are they primarily tax administrators? A tax administrator is looking at the bigger picture. You're looking at businesses. Like I said, FRS is a shareholder, it's an equity holder in all the businesses. So they're looking at what helps the business. What are the commercial reasons you're doing this? Does it make sense? Is it a good business decision? Even if you're going to reduce taxes to be collected, but does it help the business over the long term? And then is it within the confines of the law? And then why should I agree or not or disagree? So that would be an administrator's perspective. But the tax collector's perspective, we just look at the tax that can be potentially lost and say, no, why would I agree to this? And if the primary driver of FRS is to collect taxes, then why would I agree to any tax planning or advanced ruling that receives their take? So that's why I keep talking about the issue of trust. If you see it as adversarial, like what money doesn't go to FRS stay with the company, what company doesn't stay with the company goes to FRS. So it's really a question of who gets the money. Then it will, I don't see taxpayers being confident to go disclose their issues to the FRS. Now, but we have, and I'm going to give credit to FRS that in the past, we've had instances where they agree with us, even when it was not necessarily favoring more taxes.
There is this exemption, or should I say it's really about zero rates for the purpose of VAT, and maybe it's about that time when we should quickly talk about VAT. And so, Yemi, I'm going to talk to you about VAT with respect to issues around fiscalization and all of those. But then I want you to just chime in on the conversation around a new list of zero-rated items that would then include things like basic food items, and of course, electricity generation, transmission services, exports. But then it says oil and gas exports are excluded, right? What's the implication of that for businesses, especially within the energy space? If you say that certain things will be exempted, Chinedu will come back to you later, but Chinedu, I'd like to hear from you.
Thank you once again, Tokbe. Another interesting provision in the tax law. If you look at our VAT system, and I think it's similar to what you have in most places around the world, you have the input-output mechanism that allows you to recover your input VAT to the extent that that product or the item you want to charge VAT on is vatable. You are able to also charge output VAT, then you are able to recover your input. Now, what zero rating does for you is that it also allows you to continue to deploy that input-output mechanism as against having an item that is completely VAT exempt. An item that is completely VAT exempt doesn't allow you, to do that input-output mechanism. So what this does for businesses generally is the fact that it's that zero rating. If I look at manufacturing, for instance, what it will do is that it will reduce the cost of inputs. So manufacturing inputs, it reduces their production cost essentially. And of course, supporting import substitution objective of the country, which is to say, look, let's produce more. Now, if you have cost of inputs reduced, obviously it will reduce the entire production cost. So those companies can leverage this incentive to enhance competitiveness and of course while contributing to national development. So it too benefit companies that are engaged in value-added production. Again, if you have a company who's engaged in, let's say, agriculture and food processing, this zero rating also benefits such companies because the inputs and the cost of inputs will be reduced. When you remove that VAT burden, it kind of affect the entire value chain. Now, if I come to companies within the energy space, it's quite interesting because if we all know if you look at the power sector, for instance, the power sector has been bedeviled by liquidity issues. A lot of the discos have been declaring losses for a very long time. So by introducing zero rating, what it means is that VAT will no longer be charged on certain items. If I take, for instance, a Genco that buys maybe turbines or spare parts and all of that, such a company can then claim input VAT without charging VAT on the electricity that they've generated. So when you take out that VAT burden, it reduces the cost and also impact on their cash flow. So when you reduce that indirect tax burden, it kind of frees up more working capital for reinvestment. We've been talking about the fact that discos, for instance, have not been able to make the kind of investment in infrastructure that we need in the country, in the power space. Every day you hear about the national grid collapsing because of the kind of infrastructure we have there. The distribution network, has been what it's been over the years with very little or no investment in that space. These companies are struggling with collection losses. They are also struggling with electricity theft and all that. And all this is because of cash flow issues. And without the needed cash flow, it's very difficult for these companies to make the kind of investment that we are all clamoring for within that space. It's difficult for certain the investment within that space to be attractive. So by taking out VAT, not that they are not able to, they can charge VAT, but the VAT will be charged at 0%. What that does is that they stand the chance of being able to implement input-output mechanism or even apply for a refund or do an offset. And that has huge impact on their cash flow. It improves business case for new energy projects, particularly the renewable energy space, for instance, and transmission infrastructure. So because you need that extra cash to make the kind of investment that we need in transmission infrastructure. If I bring it down to consumers, for instance, you and I who consume power, if VAT has been taken out of the value chain, for instance, we could potentially see a reduction in the power cost in what it should be, because the entire value chain no longer suffers VAT. The Gencos will not suffer VAT. The distribution companies will not suffer VAT because VAT has been taken out of the value chain. So that kind of frees up a lot of cash within that space and encourages investment in other areas like renewable energy. And I think this all aligns with Nigeria's energy transition goals, because lowering the cost of entry for investor, makes it a bit attractive. So for me, it's a welcome development. Companies will essentially benefit from it. And I think it's one that they've been clamoring for. In the past, we've had certain amendments in the VAT with respect to VAT that kind of speak to this particular industry, but having it embedded within the NTA I think is a welcome development because it will help this space. It will help free up a lot of cash. It may not be immediate. Don't forget that the industry is, is is dealing with a lot of debt itself and liquidity issues. So, but over time, we may likely see some significant improvement over the years, where this the impact of the VAT really begins to take effect within the industry. Obviously, they will have to deal with the debts that they're currently carrying. But I think, bearing in mind that I think having to not worry about VAT within the value chain helps these companies to kind of, scale up and make the kind of investment that you want them to make.
Thanks a lot, Chirindu, and I think again I'm happy, right? The last time Yemi spoke, I said I wasn't sure whether I should be happy or sad, but this time around, I think this makes me be happy because there are encouragements, and of course, it's not all about the laws. It's also about some very interesting provisions, and I'm sure Yemi has some good news to share about the e-invoicing, even though we know that very many taxpayers are also saying, what exactly is this new thing for us, and how does it mean we have to spend more with respect to implementation? What do you think it will do? What are the challenges? What's going to do for the entire business space? Are there some benefits for taxpayers? Apparently, Section 151 of the Act talks about how companies should now fiscalize their systems, like engage where the FRS or the NRS now engages some third-party technology tools for the purpose of having direct insight into the sort of invoicing that organizations do. So, Yemi, I would like to speak to this, and then I'll come back to you, Chinedu, to conclude your thoughts on the issues around advanced rulings and the disclosure and the plannings that we were talking about earlier.
Yeah, thanks, Tope. You see, while listening to Chinedu, I think Chinedu's optimism with respect to the impact on the citizens, on respect to the adjustment made in the law, is based on the premise that investors and companies do not take the upside of the benefits that the zero rated will trickle down to the customers. And I think that's what the government is expecting, that if we're giving you expanding the zero rated goods, we expect to free more cash for businesses, and also that working capital benefits should trickle down to the cost of the product, and then the citizens will benefit from it. But if you look at the whole VAT regime holistically, you follow the conversation when the committee was having engaged with stakeholders. Their intention was to take the rate of VAT to 10% and then allow more inputs, remove the restriction on the input VAT that can be claimed, and that will be compensated by an increase in rate from 7.5 to 10%, and to provide some form of balance in that area. And they also intended to reduce CIT rate from 30% to 25%, which is an alignment with global best practice. Generally, it's advised that you increase indirect tax and then you reduce direct tax. But the committee wasn't successful in increasing the rates of VAT from 7.5% to 10%. But they've expanded the amount of transactions that qualify for input VAT. So you would see that there will be some revenue gap for the government if we don't look at the e-invoicing initiative critically. And I think that's why the government is paying attention to the e-invoicing to compensate for the expansion on the items that you can claim as input VAT, and their inability to increase the rate from 7.5 to 10%, there's a need to increase the tax base using technology. And that's why I personally think whatever the challenges may be, the e-invoicing initiative, from a government perspective, just has to work, so that there won't be more revenue leakages, or they can compensate for the input VAT allowance that they've introduced. But like Chiwendu said, I think it's going to be a huge impact for companies, because if you are going to be paying input VAT on services and other transactions, it's going to significantly reduce the amount of VAT that is paid to governments. And that is a significant benefit to citizens and consumers, because it is expected that it should also affect the cost of goods. For the FRS e-invoice initiative, what the FRS has done is to deal with this on a initially they started by sector basis. Then they then looked at it from a revenue perspective, saying that companies with turnover above 5 billion should key into the e-invoicing initiative before 1st of November 2025. I find that personally ambitious, because if you take Ghana, for example, it took them almost 3 years to have significant impact in that regard. But like I said, it is important for governments to make sure that the e-invoicing regime succeeds, because of what it means to VAT revenue. And if you look at provisions of the law, even though, strictly speaking, you may not be able to pinpoint any penalty based on the current tax laws, the Finance Act and the rest, which actually mandates companies to key into whatever mechanism the tax authority puts in place for fiscalization. But it didn't seem to put in a penalty for that in the Finance Act that was introduced in 2020 and subsequent Finance Acts that maintain that provision. But in the NTA is saying that if a company refuses to key into the fiscalization regime, that transaction that was conducted outside the fiscalization regime will be liable to 200,000 naira penalty, and then including the tax that wasn't paid on that transaction. So there's a huge penalty for that. And I think there's also a penalty, 1 million, 10 million, can't remember correctly, if you do not connect to the e-invoicing regime in the first place. So by 1st of January 2026, when this act becomes effective, the e-invoicing regime really comes alive with a bat. So what I would say is that companies should continue to look at their ERP, how they can actually be integrated to the fiscalization regime. They would need to speak with access point providers that have been established by or approved by this FIRS for this purpose. Sometimes, from our experience, the ERPs of companies are not able to integrate directly to these access points providers, and they may need to make certain changes to the ERP or introduce a middleware for that connection to happen. So I would say, firstly, is for companies to try as much as possible to look at how this can be done before 1st of November 2025, and also evaluate how they can make sure this is done definitely before 1st of January 2026, where the NCA kicks off. So I think there are benefits for companies in that regard. I mean, for example, we've been advocating that the FRS should carry out risk-based audits for a long time, not just subjecting every company to tax audits all the time. The fiscalization regime, where there's transparency across the board, would enable the FRS to be able to actually know those taxpayers that they should focus on. But I understand as well that there are concerns from companies with respect to cybersecurity, data protection, and the likes. I think those are areas that companies should pay special attention to through the fiscalization process. In all, I would say that both companies, taxpayers, and the government have it to do with respect to fiscalization regime. For the government, it just has to work. Otherwise, there's going to be a dip in VAT revenue. For taxpayers, they don't want to fall on the wrong side of the law where steep penalties will apply and compound on a daily basis. So I'll say that we're in a new regime, a new system, and all hands has to be on deck so that we are on the good side of the law and not on the bad side. Thank you.
Thank you very much. And apparently, we hoping that this sort of system would also ensure that there is less of conversations in terms of reconciliation, where the FIRS already has the invoices in their own portal, right? And so there shouldn't be so much around when the FIRS say to you that you have alleged undisclosed income, right? Hopefully going forward. So Chinedu, I'd like to get your concluding thoughts regarding the issues around, advanced ruling just before we had that network glitch earlier. And then I'd like you to also just talk about some things. Okay, well, I'll just wait until later because, again, many of our participants are asking questions around personal income tax. And I think this is something that bothers everyone. So we're saving the best for the last, right? So come to that conversation and everyone talks about it. But you need to please, I want to have your concluding thoughts regarding the advanced rulings.
Yeah, thanks, Toby. Sorry, I had network glitch. So yeah, the final thing I wanted to say about the disclosures and advanced rulings is that having explained the pros and the cons, at the end of the day, the FRS's views on the advanced ruling or disclosure is not necessarily final. So the fact that a company had notified them or went in for advanced ruling and FRS rejected it or didn't agree with it does not necessarily mean that the company cannot go ahead. It just means that there's a risk that FRS will review it and disagree when they come for audits. And if that happens, there are dispute resolution measures. We're having the tax ombudsman, we already have the tax appeal tribunals, we have courts and all that. So when there are disputes, there are resolution processes. But for most businesses, they want to be able to quantify their risk and know whether it is even what is in the first place. But if the companies feel strongly about their position, and if based on their own reading of the law, because they can read the law, FIRS and the companies can read the law and understand it differently. Based on their own reading of the law, if they think the law is on their side and FIRS is not agreeing, they can still test it. So the idea is not that once FIRS said no, then that's final. But it's just supposed to improve the level of transparency for both FIRS and the company, so that even where are disputes, we are clear on what the company is thinking and what FIRS is thinking. So that's what I wanted to say about that before my network went off.
Thank you very much. And I think that's a very sound advice to realize that we are all stakeholders, whether we're consultants or taxpayers or the NRS or the FIRS, as the case may be. No one necessarily has the last say until certain situations could even proceed to the court if there is a need to do that. But it just helps for certainty sometimes that everyone is clear about what is practicable. It's not all issues that have to proceed to the court, or we need external arbiters to decide what to do. But very sound advice with respect to the point that, yeah, you can proceed to do what you intend to do regardless of the feedback from the FIRS or the NRS. Okay, we are gradually coming to a close, and like I mentioned earlier, very many of our participants have lots of questions around personal income tax, and I think that this is something that impacts Chinedu, Chiwendu, Yemi, and so everyone's got to talk about this, right? The first thing is that there is this graduated tax table that has changed, and with this, it means that people who earn not more than 800,000 naira are now exempt from personal income tax, but the highest marginal rate is 25% as against the current 24%. And of course, people who earn above 50 million, and we know what has happened with inflation, how sometimes people have increased their take home, I mean, their gross salary, I would say, but it doesn't actually change the actual value of the take home. So I'll start with you, Chiwendu. What do employers need to do with this commencement of the Nigerian Tax Act and these particular provisions with respect to personal income tax? Employers have something to be worried about, or don't they?
Well, I would say that just like every other, lots of the provision that you have in the Act, the game has changed essentially. In the past, we had several rooms to maneuver to play around in terms of managing your tax obligations from a personal income tax perspective. What we have now is a situation where a lot of things have been taken away essentially, and you get to pay more as you earn more. Yes, we have that provision that seeks to exempt those earning about 800,000 thereabout. But the question then is how much of the income tax really comes from that group of people in the country, right? Yes, there might be a lot of that coming. There might be some percentage that goes in. So when you look at those who earn much more than that, you realize that what is going to happen is that you are going to have to pay more taxes, right? So what I would say to taxpayers or employees is to, first of all, you need to do like some form of analysis. Look at what you currently earn and put it on and compare that with what your taxes will be today and what it will be come January 2026, and see if there are rooms for any maneuvering. If you ask me, there's very little room for any maneuvering. I mean, I stand to be corrected. But like I said at the beginning, a lot of the incentives that we used to have, or we currently have in personal income tax acts that we could use to play around, have sort of been reduced or taken away. So you have very little room to play around. And there's also requirement for disclosures and all that. So I think it's what the law is doing now is to shine a larger touchlight on everyone, and where your income has to be fully disclosed, and you have very little room to play around. So you and I will pay more taxes come 2026, depending on what you earn. Like I said, it's graduated. As you earn more, you potentially earn more. But you can then look into other ways of managing your exposure. Maybe you want to look into putting more money into your pension, because you still get exemptions in that. Maybe you want to put more money into your pension for tomorrow, and take a deduction for whatever amount you put into your RSA account. Look into other areas where you may then have to put more of your money into certain investment to bring more return. Investment that may be tax exempt, like investment in government bonds and all that. So I think it's going to force everyone to begin to look to see how what you earn, how much more what you earn is going to earn for you, given the fact that a lot of what you currently earn may be exposed to tax come 2026.
Thanks, Chiwendu. I like the advice to put money in investment or pensions, but some people will say, YOLO, you only live once. Spend the money today and then let tomorrow take care of itself. But it is what it is. So interesting times coming ahead. Chinedu, so there is this extended meaning of residence to include individuals that have substantial economic and um, immediate family ties in Nigeria. And I've gotten maybe one or two calls from friends who live outside Nigeria to say, hey, it looks like they will tax anything I send to my Nigerian accounts right now, personal income tax. So this sort of provision seems to be widening the tax net for personal income tax. And there are concerns that people will now have to pay tax on their worldwide income. For those who live outside of Nigeria, they visit the country, but they don't necessarily work in Nigeria. What are your thoughts in that regards? Personal income tax matters now.
Okay, thank you, Tome. First of all, I just like the CGT, I also didn't think this was the time to increase government stake on personal income tax. And this is my reason. If you step away from tax, right, and look at the bigger economy in terms of the reforms that we're going through, you have the public sector, you have the private sector. Within the private sector, you have the individuals and the companies, right? Over the years, we've said, oh, government is spending so much subsidizing the people, and so government is wasting money, it's inefficient and all that. Fine. This government have then decided to take back most of those subsidies. So you look at the petroleum subsidies, you're looking at electricity subsidies, and you're looking at FX subsidies. All this has moved back to the government, and the cost of living crisis was significant. People are really, really, really paying through their nose for anything. People's monthly expenses, we are talking about 3x, 4x, 5x, increase in expenses. And on the convert, governments are awash with cash. I mean, we hear state governors are getting 4x what they were getting before, so much money being distributed, which is fine. Is this really the time to then still increase the tax rates for individuals so that governments will still get more? You have to, balance these things. I didn't think, this was the time to increase the take from the people to the government. But again, that's just my view. Now, going to what people should be doing. Definitely, by now, companies should be running models, running their, payroll models to see what that means for individuals, and looking for, like someone said, if there's any limited space for, still tax planning around personal income taxes. I know there are requirements, for example, for rental, to evidence for paying, because the only deduction, one of the deductions we have now is, that the rental, 500K rental. What kind of disclosure would they require? Is it receipts from your landlord or whatever? We've discussed that at certain fora with the committee, and it wasn't clear. They're going to still issue some directives on that. But those are kind of things that HR should be worried about. Okay, so what kind of information do I need? And then if there are people taking advantage of things like housing loans, premiums paid on their insurances and all that, what kind of documentation should HR be asking for? Those are right away. It is good that the least earners in the economy are not going to be paying, because, like I said, the cost of living has been hellish, for everybody. But even for the so-called middle class and the upper class, I mean, their own costs has also significantly improved. I would have preferred that you gave a couple of years to even allow things to settle, because there's really just so much you can push people towards. Well, let's see how the implementation, happens from next year.
Thanks a lot, Chinedu. And if you think about again, one of the gains that this government seem to have made with respect to the foreign exchange, we talked about the foreign portfolio investment earlier, but some people would also say that diaspora remittances has played a very great role. And if you are then having something changing with respect to personal income tax for those people who live outside of Nigeria, work outside of Nigeria, and they would have some implications for their taxes in Nigeria going forward. It's something to be concerned about. Chinedu, do you want to say something more?
Yeah, okay, let me talk a bit more about the offshore guys, because I also got a lot of people from Canada and wherever saying, what does that mean for us? Clearly, and I think Taiwo, again, to his credit, has reached out. I think he had a session with some non-resident Nigerians to explain that Nigerian taxation has always been based on residence. So the fact that there's money in your account does not necessarily mean that that money is taxable in Nigeria. Before you are taxed in Nigeria, it has to be some residence. Now, but what does residence mean? Residence doesn't mean you have an employer in Nigeria. So if you're working in Canada or in UK and then you came to Nigeria and you spent 6 months in Nigeria still working for your UK employer, you might become resident in Nigeria and you might become taxable for that year. And the good thing is that before now, your presence alone in Nigeria could have created a PE for your UK employer. But because the country, we want to attract such kind of companies to employ Nigerians to work like remote workers. So this new tax law has clearly said that presence of employers in Nigeria will no longer create tax presence for their employers. So you can have employees in Nigeria working for an offshore entity, and that foreign entity will not be taxable on its own company's income tax, but the employers in Nigeria will have to pay their PIT. So the same way, if you're a non-resident Nigerian, but you then spend more than 6 months and 183 days, because that's basically how we track a residency. And most countries have that, not just Nigeria. Then you might have to account for taxes in Nigeria. But that's the only scenario where I see a non-resident person maybe being dragged in. But the fact that you send money or you have an account in Nigeria or things like that will not necessarily create a tax presence for you in Nigeria.
Thanks a lot, Chinedu. I hope that at least the fears of some of those people asking the question. So we're gradually grinding to a close. Yemi, I want you to speak to people that are in Nigeria. Right, there is the exemption on 800,000 naira. I've got a couple of participants asking questions around this as well. Do you really think that it moves the needle with respect to the current cost of living in Nigeria, price level, and the sort of inflation that we faced in the last couple of years? Again, this is not just about taxes, this is about looking at the economy and saying whether this is really what, I mean, some would argue that it's going to wipe out collection for the tax authorities. Some would say, hey, it doesn't really mean so much in terms of living expenses for people.
Yeah, so it depends on how you look at it. I mean, anything is to go by, depending on the reports that you look at, between 80 to 129 million Nigerians are living below poverty line. So, and they were not paying taxes anyway. So with the exemption, to a large extent, it may reduce administrative burden. But if you look at the workforce, especially civil servants and all that, and the minimum wage, and what some low-income earners earn, it falls within that bracket. And we've had some state revenue service say that a bulk of their taxpayers fall within that exemption range that this law has now exempted them from taxes, and it will affect their collection. So from their own perspective, it may move the needle. But from the larger economic perspective, in terms of government revenue and impact to the economy, there's this adage that says that you cannot tax, you shouldn't be taxing poverty. You cannot tax your way to prosperity. So if we are going to boost the economy, we need to have such exemptions for the vulnerable in the economy, so that, in the words of the president, we allow the poor breathe, you understand? So I think on a personal level, it's good for those who are below that income threshold. It will have an impact on their disposable income. The economy at large, I'm not sure it will have significant impact given the number of people that are earning below poverty line. But on a lighter note, I want to advise my colleagues, Chinedu and Chinwendu, who are wearing glasses, that there's a provision in the law that allows them to claim exemption for the cost of their glasses when they are filing their returns to reduce their, because
Interesting.
I believe they may fall in the upper cadre of taxes. So I would say that there are some hidden gems in the Tax Act that companies should familiarize themselves with it, talk to their consultants. There may be one or two incentives that will be beneficial for them in reducing the tax burden. But I agree with Chinedu that it could be steep, especially for those who are already compliant. Moving to 25% could be a lot. Thank you.
All right, thanks a lot, Yemi. In the spirit of claiming exemptions for those who wear glasses, I want to take the final words, your final thoughts, Chiwendu, and then I'll come back to you, Yemi, and then Chinedu. Chiwendu.
Yeah, thank you, Tokwe. I may need to go and invest in more glasses so that
I
I could
see.
potentially have deductions to claim on my tax return. But just in a final note, I think what I would like to say is that the NT obviously is kind of signals a new era for Nigerian tax regime. It offers a mix of incentives and obligations that, in my own view, can reshape industrial growth if properly leveraged. There's certain incentives, and I think, like Yemi said, taxpayers need to, work with their tax consultant to begin to take a closer look at the law to see where incentives can be, adopted, or taken, to help their businesses. But at the same time, the Act also demands greater compliance discipline. I think in one of my comment that I made, I said it won't be business as usual anymore. So it requires, or rather, demands a greater compliance discipline, including mandatory e-invoicing that I think was spoken about, and stricter reporting requirements. And so to fully benefit from this, I think businesses must act swiftly by reviewing their tax strategies. I think we talked about you getting advanced ruling, updating internal system like ERP, to comply with e-invoicing, ensuring that their team understand the new rules. So businesses that stay updated early enough, those who want to be proactive, in my view, are the ones that are best positioned, to ensure compliance. So that would be those would be my final note to say, look, it's a time for businesses to be proactive, evaluate the impact of this new law on your businesses, make tweaks where required, and then get your tax consultant to work with you hand in hand to make sure that you have a seamless transition from the current law to NTA come 2026. Thank
Thank
you.
you so much, Chiwendu. Yemi, your final thoughts.
I would say Chinwendu has spoken a lot on what companies need to do. For me, will be on the government. Reading through the acts, it will appear that enormous powers have been given to the tax authority. I would want to advise that we are all learning in this new regime, and where they have powers to impose steep penalties, they should do so in a fair and equitable manner. And also, it would be nice to have those guidelines that they had promised to be issued before 1st of January 2026, so that companies can familiarize themselves with those rules, so that by 1st of January, there's a lot of clarity and certainty in complying with the provisions of the law. I would also say that it's a new regime. These are new laws. We all don't, we can't beat our chest to say that this is how it's all going to evolve, and this is how it's all going to impact the economy until we actually implement it. I would want to say that we shouldn't be too rigid. If an aspect of the law has significant adverse impact on the economy, we should make amendments to those aspects, and we should just adjust as we go along and not be too rigid. The taxes shouldn't override economic decisions. Investors should be able to come in and invest in the economy, being sure that they'll be treated in a just and equitable way. So that will be my parting words. Thank you.
Thank you so much, Yemi, and I come to Chinedu.
Yeah, I mean, thanks. I guess I will start the way I will end the way I started again by thanking the guys that did the work. I think the work was very well done. Simplifying the laws into one act, is a significant move. We had so many different taxes, even at different levels of government, and the effort to pull everything together and make it simple, I think, is a very, very, very good effort. As Yemi said, it's largely positive, but it's not without challenges. And thankfully, they are given enough time for people to get used to it and read it through. And that's what companies should be doing now, getting used to it and doing their models and understanding the impact assessment, exactly how they're going to impact them. Like I said, I don't, if going by what's going on in social media, sometimes the what attracts people's attention are not the main things. People just pick one thing and run with it. But for companies, you have to do a deep dive and really understand how it affects your business. And as we start the implementation, there will be challenges on both sides, because as FIS is getting used to it, companies are getting used to it, and we should open to mutual understanding and resolving issues quickly. Over time, I think it will be largely positive for the country. Thank you.
Thank you so much, Chinedu, and thank you to all our listeners and our audience. I want to sincerely thank you for joining this session. It's been enlightening how we basically talked about this dynamic and evolving tax landscape in Nigeria. I want to sincerely thank our panelists again, Chinedu, Chiwendu, and Yemi, for distilling those complex provisions, providing clear insight and the very thoughtful engagements. Apparently, we can't exhaust the conversations here, but as we look ahead, it's important for taxpayers, for practitioners, even the government to remain proactive, understanding that, just like Yemi has said, don't be too rigid. It's not just about what is changing, but we also need to understand why these changes matter for business resilience, for competitiveness, for national development, right? And so the conversation shouldn't stop here. If you've got questions, reach out to us at Andersen. This is what we do to ensure that reforms translate into real value for both the government and the private sector. On that note, I want to thank you everyone for your time, for the participation. I want to encourage you to stay informed, to stay compliant, to stay ahead of the call. Have a very good day, everyone. Thank you.